Hey, morning everybody. Adam Crosley here. Today is December 17th, Thursday. I just wanted to reach out. As you may or may not be aware, the Fed has increased interest rates. It hasn't happened in 9 years. It's well overdue, okay? Um, but I just wanted to shoot you a quick little video and just kind of help you better explain how this is going to affect you and more importantly your clients in the coming year, okay? So essentially, today versus yesterday, interest rates are a quarter point higher when your client goes to borrow a mortgage. So let's say they're buying a $150,000 house, taxes, $3,000, insurance, $600 a year. That payment for that client is going to be 1,100 and just over $1,100, like 1102. Okay, that payment today has gone up $22 just because of that Fed interest rate hike. Okay, so that payment is now up $22 a month yesterday versus today. Now $22, it definitely not the end of the world, just a few lattes or whatever, but $22 extrapolated over that 30-year period, that's just shy of $8,000. It's $7,920. So is that big of a deal? Well, it is, but the Fed has basically said that through 2016 they expect to raise interest rates 1 full point and sometime over the next year. Now the Fed has 8 meetings every other month throughout the year, and so essentially, what does this mean to us and to your clients at the end of the day? Well, if your client is kind of on the fence whether or not they should buy now or whether they want to wait till spring because they don't want to move in the winter, well, this is a talking point that you can bring to them that's going to help get them off the table. So if at the end of the first quarter the Fed does increase interest rates again, well, that same payment, nothing else has changed, has gone up $22 again. So now the payment's $44 more than it was yesterday. Well, $44 extrapolated over 30 years is $15,840. And then let's say they wait till after July to buy the house. And then the Fed raises interest rates again by a quarter of a point. That same house, that same $150,000 house with $3,000 a year in taxes and $600 a year in homeowners insurance, the payment's gone from $11,000 to $1,170 a month just by waiting until July. So the payment's gone up $70, $16,000 over the course of the year. And let's say they wait until September, interest rates have gone up a full point from where they are or where they were yesterday. That same payment on that same house has gone up to $1,192. So that client that's on the fence, their payment are going to keep going up the longer they wait. So this is just a talking point that you can bring to the client. If you do have clients on the fence that are maybe interested in buying now versus waiting a little bit to get whatever in order. Interest rates are going up, and that's just going to be an extra cost that your consumer has. So just a quick little tip I wanted to share with you guys this week. Hey, I hope you guys have a Merry Christmas if I don't see you. Thanks so much, and if you guys ever need anything, here to help. As always, talk soon. Adam Crosley. Bye now.